Hello and welcome to another one of our Macro Mondays. It's episode 9, and this week we have a ton of good topics to talk about. So let's get right into the podcast. Now, this week, the week prior to this cut that we've just had, you would say that the market was definitely pricing in 25 basis points. However, Monday, Tuesday, Wednesday, it went and swapped into the 50 basis point camp, and there was a relatively sizable gap in terms of probability of a 50 basis point cut going into it. And J Powell did make that 50 basis point cut happen. Now, there are some interesting and notable parts of this story. One being that they didn't have a unanimous decision. So there was a dissent in the camp of the 50 basis point cut. However, if it was to happen the other way around, you would have had members of the Fed that were advocating for the 50 basis point cut. So, either way, you were going to get some disagreement there, which hasn't often happened in the Fed history of cuts. On top of the move towards the 50 basis point cut, the US government also came to the Fed and wrote the Fed letter saying that they needed to cut 75 basis points in order to stop the chance of a dramatic slowdown in the economy and to kind of help the situation out. So the US government, Elizabeth Warren and her cronies, want 75 basis points. They didn't quite get that, but they got 50. It was interesting to have that letter come out just before the cut too. So I don't know how much to read into that. It was interesting. There was no way that they were going to up the cut to 75. The cut was positioned as kind of, we're all good to do this, but don't expect us to keep going 50 kind of thing. Like, the economy's still strong, labor market's still good. This isn't a panic cut. And, the other thing you should note is that, we're not going to probably do 50 again for a while. I don't know. There was a lot of confidence with J Powell, but it's so hard to predict what happens from here. I think chances are they're probably still behind the curve. So we'll see how things go. But, there's been so much, and I often think about this, there's been so much around this cut. These spectacles around these federal these Fed meetings and these rate cuts, they become this huge spectacles, and really the only winners are market makers in this. And when you trade these events, there's a high probability that the casino is ultimately going to win. But here we have some examples, and there are thousands of these charts in the market at the moment, and leading up to the event, I would say that it was very clear that the sentiment in the market has moved over the last week and a half towards very positive towards rate cuts. Whereas, context is everything. Anyway, from here, this is a chart that's very much focused on how large the first cut was and then what happens to the market after that. You would see in the example of 1995 and 1998 and 2019, there were 25 basis point cut in the beginning. The first cut was a 25, and markets rip. Over the next kind of 6 to 12 months, at 2 out of the 3 examples there rip higher without extreme volatility to the downside. 2019, there was a bit of a tantrum there, and you see it bounce back though. And I think that could have actually potentially been coinciding with the pandemic. So this may be a little bit irrelevant. How it was playing out in 2019 didn't really come to fruition because it was interrupted by a global pandemic and a mass shutdown. Okay, 50 basis point cuts. There's 2 graphs here, very clear. Poor for markets. Both of those examples, however, being 2001 and 2007, so extreme examples. And there's a slightly different tone to the Fed rhetoric in this example here in 2024. So what does this mean? I guess context is everything. Here's another chart taken from the data provided around different rate cut cycles. There are more this time. You can see the green shaded sections are where the market was up after 3 months, 6 months, or a year. And there are more green shaded areas than non-green. But context is everything. So let's take a look here in more detail. So you have the 73 rate cut and the 74. The 70s were riddled with inflation and then recessions. So there was a lot of hard times in this period. The rate cut was followed by a rise in unemployment, no yield curve bull steepener, but the SARM rule was triggered, and they're basically the same indicator, unemployment moving up and the SARM rule will kind of go hand in hand. However, when you're thinking about recession, and actually if you go back to the chart previously, if you think about these examples, 95, 98, and let's just say 2019 let's just take it out of the picture. 98 and 95, no recessions. That was actually as a part of a rather dramatic bull run in the dot-com era. 95 was the start of that, and then 98, it was almost the top of the multiples through that cycle. So that was what was going on there. No recession had. 2001 and 2007, both examples of recessionary outcomes. So the market is basically saying, and most of the charts that you'll see basically go, well, if there's no recession, market's up, let's call it 15% over the next 12 months and potentially even as much as 50% over the next 2 years. And if there's no recession, then you shouldn't own equities. This is what people say. This is not my view. The market or market commentators are saying, oh, well, equities are in trouble if there's a recession, and if they're not, everything's great. So I guess the question becomes, will there be a recession in the US? Can you predict a recession? Most people say no. I would say on a reasonable time frame, probably not. But there are some indicators that you can look at that predict recessions. Two very keen indicators would be a uninversion of the yield curve and a sharp bull steepener, where basically short-term rates are going down sharply against long rates. So that's happening right now. And last Macro Monday, we actually showed a chart of the uninversion, and it's only getting steeper. So that's a poor sign. Typically after that happens, or during that process, the US has gone into a recession in the past, approximately 90% of the time. And then you've got the SARM rule, which is where basically unemployment goes 50 points above the 6 or 12 month moving average. So basically unemployment's rising. And then I've got the chart where I've got unemployment here as well and how much it moves over that period. It's really difficult to actually get the data in a very clean way, so I've done my best. But you get the general direction as well, so it is quite useful. So that's quite a nice piece. And then I've got this true false, whether 2 of the 3 have been met. I'm not sure how great this is, considering unemployment move and SARM rule are pretty much connected. However, unemployment rising, bull steepener, SARM rule triggered. For me, 3 really interesting indicators when you're trying to work out, are things actually going to go into recession? Because we've been many of us have been expecting recession for an extended period of time, and it's just not showed up. Another interesting piece to look at is the multiples. Traditionally, you would see that there's not too much correlation, you could say, with high multiples and low multiples and whether or not there were corrections. You have large corrections when multiples are high and when they're low, and you also have good performance when multiples are high. Interesting, you would say, though, that 1998 was really the kind of almost the height of the bull market in terms of multiples, at least. And then you look at 2021, multiples have come in a bit, they're lower. Anyway, I think it's just really interesting to note where multiples are versus some of these examples in the past. You can definitely say that multiples at the moment are elevated, between 27 and 29 PE ratio on the S&P. That is very expensive. So definitely important to know. I like to know how expensive assets are in relation to whether or not I want to purchase them. 2024 is the most expensive that we've seen out of the last 13 rate cut cycles. Now, if you were to predict a recession, then 75% of the time in this example, you would see huge volatility in equity markets, and they would reprice for a time before, in most cases, recovering within a year, which is typical. So FedEx adjusts forwards guidance down. They missed on the earnings and the revenue. I think the revenue is an important one, even though it's 1.24% miss. It is important because you can't fudge those numbers, but also they missed significantly from an earnings perspective. So they've been absolutely hammered, and they've had some really volatile couple of earnings seasons. So this one, no different. They talked about basically people are going down in value, purchasing slower deliveries in order to save capital, which makes sense with the current environment we're in. Another interesting and continued action from Mr. Buffett would be that he has been continuing to sell down his Bank of America shares. He is very close to owning less than 10% of the company, which would then mean that he does not need to report future sell orders of the Bank of America position. So over the next 1 to 2 months, he could reach under 10%, which would mean that he does not have to do early filings on his purchases and sell orders of Bank of America. So that's really important to note. And, it makes us question, well, why is he doing this? We often talk about the succession plan and how it's good to have a clean slate, or as close to a clean slate, for the people that are going to be the succession plan for Berkshire. And then other market pundits will talk about, actually, he's in the game, he's in the arena, he's actively trying to protect Berkshire's capital and make solid investments, and as a part of investing, you have selling down your positions. And as of today, I believe that his remaining position is pure profit. So ultimately, an incredible trade that he's held for quite some time, and he's dramatically reducing his exposure. So now on to the poison. What will the US pick? The US has to pick their poison. And something that's being talked about a lot at the moment is the deficit. So with the deficit, you have to work out how you're going to reduce it, of course. Most of the time you have a deficit, it's in poor economic times. So for example, if you have a recession, your deficit will likely increase because you'll have to do more government stimulus and spending programs and backstops in order to basically stimulate your economy. But we already have, in the US at least, and most Western countries, quite sizable deficits. And in the US's case, they have created incredible amounts of debt, so much so that their interest expense is higher than their defense spending now. So this is a looming issue, and there's about $15 trillion of treasuries that have to be refinanced, essentially, and they will basically roll on, and they need to refinance it. So that means even if the US the Fed, even if the Fed was to cut rates, they need to cut them very aggressively if they're going to actually allow the US to not have a kind of large increase on its interest burden. So what does that mean? It means that either president of the US, now whether or not they can get something done because of how the Congress and the Senate is going to all fall is a different question. But ultimately, both presidents in theory are going to have to address this deficit. The thing with Trump is, based on his campaign and based on some of the rhetoric he's been talking with RFK Jr., Elon Musk, and others, would suggest they're going to try and make a lot of executive orders to basically dramatically cut government spending and inefficiencies in the government. That's one of the things that they're running on. And that makes sense because the US government basically attributes, I think it's almost or just above 50% of their GDP, or is somehow attached to it. So the consequence of dramatically cutting the government would be that you would lose GDP, because you're basically saying, hey, I'm going to cut a bunch of government spending and government programs, and that revenue will ultimately mean that there's less GDP. And then the tariffs are risky in terms that they could be inflationary, but I don't have too much of a view on tariffs. I do find the idea of Trump getting in and doing massive government spending being pretty interesting, and also a real consequence for US GDP. And then the other piece would be unrealized cap gains tax that the Democrats are pushing. Now that's interesting too. What we've seen is a few hedge fund managers kind of talking poorly about this situation, and one mentioned they would basically pull their funds from the US market if Harris got in. So again, who knows if they'd actually do that? Probably not, but who knows? What I would say though is that there's this deficit issue. Both are going to try and attack it in some way or another, and it always comes down to either taxing to get more revenue or cutting your spending. And this issue has been bubbling along for probably 40 years. People have been complaining about it, but is becoming acutely in everyone's front vision. So now something's going to have to happen. Otherwise, you would have potentially risk of some tail risk events with the US financial system, which no one in the government, no one in the US wants to actually have happen, and private business owners also don't want to happen, because it would be devastating for the US. NZ per capita recession, so 7-quarter loss streak, which is nuts, but kind of makes sense. One thing I would say is keep your head up. If you're in New Zealand and you're dealing with this, this is an extraordinary long period of time to have this sort of difficulty. And it was coming on the back of huge amounts of inflation and unrealistic expectations of spending and interest rates. And there was just too much credit out there. And it really actually is going to go down in history as some of the kind of worst sequence of events ever in terms of our economy, at least. But then also globally, I would say that will end up being the case. When you look at the slowdown in New Zealand and you look at how they came in as well after the election and cut a lot of government programs, you can see what consequence that's had for New Zealand's economy. And it could be a little bit of a kind of sneak peek to what will happen to the US government and the US economy if Trump was to get in and actually successfully cut government spending. Whether or not it was the right decision, I would say that there's a lot of reasons why you would want to cut spending, and there are a lot of reasons why you wouldn't. And, our economy was attached to a lot of real estate loans where we don't have 30-year mortgages. So that's a really big deal. So the people in the US that have mortgages at 3%, they're an asset, whereas in New Zealand, the longest fixed term rate you're going to get is 5 years. So given that we didn't have this 30-year buffer where we don't need to sell, it's created, volume in the market, which means that houses are selling, unlike the US where they're not. And that's meant that prices have naturally come down dramatically. That may have happened in the US, you see, if they didn't have 30-year mortgages. The same dynamic could have happened. And then we've also had to deal with the fact that China has been extremely slow for a very long time and coming into deflation territory. So that's also played on our economy, mixed with lots of natural disasters, which have consequences for people, disruption of productivity, yields on crops, not getting the exports that we needed to go to China because they're slowing down and we may not be getting the yield that we would have wanted. And, the tourism industry has been pretty uninteresting from a New Zealand perspective for a while. Perhaps New Zealand has lost some of its allure, at least in the short term, mixed with the fact that people have been struggling and there's been a global cost of living crisis, which may have also affected our tourism. 7 quarters is statistically much longer than you usually deal with. We are almost definitely closer to the end than the beginning. So this is the time to hustle. Most likely, this is probably the time to hustle and find ways to increase revenue, find ways to build businesses, and make a difference. The bad times are the start of growth and building new things and creating productivity. So anyone that goes out there and hustles and survives the next couple of years is going to be a net winner. So think of a very long lost streak as an opportunity for a long and prosperous period going forward. And that's the best way I can really describe it, especially when you look at market history. 7 quarters, statistically, very long time. So we should look at how we can increase revenue, increase productivity, export globally, especially if you're selling digital products, and get amongst it. Another NZ-related topic would be the NZD trying to strengthen. It's actually up over the last 6 months, 4%. So that helps us with our Netflix subscriptions, our Adobe subscriptions, anything that we consume in US dollars will hopefully continue to get cheaper. But the currency markets have been very complex, and it's not been great to own New Zealand dollars for the last couple of years. So this recent rebound has been pretty significant as the US lowers rates. Will it continue? Who knows? But it will definitely help us with our US related services that we consume. So that's a positive for sure. As always, none of this episode has been about buying, selling, or holding individual securities or any sort of personal financial advice. We don't give financial advice. We just report on interesting topical events for educational and entertainment purposes only. We look forward to seeing you in the next episode, where we uncover many more interesting topics and dynamics within markets and macro. See you next time.